A temporary fall in an investment can change your emotions. A permanent investment loss can change your future. That distinction is far more important than the number flashing on a screen, because a decline in price is not automatically the destruction of capital. A permanent loss occurs when the capital itself, or its ability to recover and compound, has been irreversibly damaged. And once that happens, you are no longer simply trying to recover money. You are trying to recover time. Consider what happens after a severe loss. If an investment falls by 50%, it needs a 100% gain merely to return to where it started. The mathematics becomes increasingly unforgiving as the loss becomes deeper. But the hidden cost is even larger, because the capital that disappeared could have participated in future growth, generated cash flow, or simply remained available for another opportunity. This is why permanent loss is not just a subtraction from wealth. It is a subtraction from the future possibilities that wealth could have created. And this leads to the first contradiction. People often think investment risk is measured by how much an asset moves. But volatility and permanent loss are not the same thing. A price can fall dramatically and later recover. Another investment can appear stable for years while the underlying economics quietly deteriorate. The screen shows movement, but the deeper question is whether the productive capacity behind the capital is becoming stronger or weaker. That is why understanding permanent investment loss requires looking beneath price. Imagine someone buys an asset because its story appears convincing. The price rises, confidence grows, and eventually the investor begins treating the market value as evidence that the original decision was correct. Then conditions change. Earnings weaken, debt becomes harder to support, competition intensifies, or the underlying asset loses its economic relevance. The price falls, but the real problem is not the falling price. The real problem is that the reason the capital was expected to become more valuable may no longer exist. This is where psychology enters the financial system. After a loss, the human mind does not behave like a neutral calculator. Loss aversion can make the pain of losing feel more powerful than the pleasure of gaining. Anchoring can make an old purchase price feel psychologically important even when the underlying circumstances have changed. And the desire to recover can create another dangerous illusion, that because money was lost in one decision, the next decision must somehow repair it. But markets do not know what you paid. The market does not owe anyone a recovery. Capital has no memory of your emotional attachment to it. That realization is uncomfortable, but it is one of the most important ideas in investing. The relevant question after a major decline is not, how do I get back to my original price? The deeper question is, what is the economic reality of this capital today, and what future can it reasonably support? Now consider the opportunity cost. Suppose a person loses a substantial portion of their capital permanently in their 30s. The visible loss is the amount that disappeared. The invisible loss is everything that capital might have contributed over the following decades. Compounding is powerful precisely because returns can build upon previous returns. Permanent destruction interrupts that chain at its foundation. And this is why two people can earn similar returns over their lifetimes yet finish with dramatically different financial outcomes. One may experience ordinary fluctuations while protecting the continuity of capital. The other may repeatedly suffer irreversible losses that force them to rebuild from a smaller base. The difference is not always intelligence. Sometimes it is survival. In engineering, a system can tolerate temporary stress if its structure remains intact. Financial capital behaves similarly. A portfolio can experience uncertainty, drawdowns, and changing conditions without necessarily being permanently damaged. But when the underlying structure breaks, recovery becomes a completely different problem. This also explains why diversification matters conceptually, even before discussing any particular investment. Concentration can make one wrong assumption disproportionately important. When too much of the future depends on one company, one industry, one economic scenario, or one thesis, an unexpected change can transform an ordinary mistake into permanent capital impairment. Yet diversification itself cannot eliminate every form of loss. It can reduce dependence on individual outcomes, but it cannot make financial uncertainty disappear. That distinction matters because the goal is not to create a world without risk. The goal is to understand which risks are temporary, which are manageable, and which can permanently alter the trajectory of wealth. There is another layer that is rarely discussed. Permanent loss changes behavior long after the money is gone. Someone who experiences a severe financial loss may become excessively fearful and miss future opportunities. Another person may become excessively aggressive, trying to recover quickly. Both reactions can emerge from the same wound. One retreats from uncertainty, the other tries to defeat it. In this sense, a permanent financial loss can become a psychological loss as well. It can change confidence, decision-making, patience, and even the relationship a person has with money. And perhaps that is why financial discipline is deeper than learning which asset moves up or down. It is the discipline to separate information from emotion, price from value, opportunity from temptation, and recovery from revenge. There is a powerful connection here with the idea of self-mastery found in the Bhagavad Gita and embodied, in a different way, through Lord Hanuman. Hanuman represents disciplined strength, enormous capability controlled by purpose, courage without arrogance, and action without becoming enslaved by the immediate result. That principle has a financial meaning. You cannot control the market. You cannot control tomorrow's price. You cannot control every economic shock. But you can cultivate the quality of judgment that decides how much uncertainty you are willing to carry, how carefully you examine an investment thesis, and whether you can change your mind when reality changes. That is where gratitude also becomes unexpectedly relevant. Gratitude does not mean being grateful for losing money. It means recognizing that capital, time, attention, and knowledge are limited resources. A financial mistake can therefore become expensive tuition if it permanently improves the quality of future decisions. The money may not return, but the lesson can continue producing value. And this brings us back to the original question, how does permanent investment loss change your future? It changes the size of your capital. It changes the time available for compounding. It changes your opportunity set. It can change your psychology. And, if repeated, it can change the entire trajectory of financial independence. But the deepest lesson is not simply to fear loss. It is to understand the difference between losing market value temporarily and destroying the economic foundation that creates future value. Because wealth is not merely what you have today. Wealth is also the future that today's capital gives you the ability to reach. Protecting that future does not mean eliminating uncertainty. It means developing enough knowledge, patience, humility, and discipline to recognize which losses are part of the journey, and which losses permanently change the road itself. And perhaps that is the real meaning of financial strength, not the ability to predict every outcome, but the ability to preserve the capacity to participate in the future. Jai Hanuman.